On May 6, 2010, the Dow Jones plummeted nearly 1,000 points in a matter of minutes. This digital ticker shows the exact moment the market broke. Shares for multi-billion-dollar companies suddenly traded for a single penny. $1 trillion in wealth vanished without an economic trigger. There was no bank failure, no housing collapse, and no coordinated attack to explain the evaporation. In the 1929 crash, panic looked like this: terrified humans on the steps of Federal Hall, watching ticker tapes in horror. But in 2010, the panic was silent. Human traders sat in stunned silence while their monitors burned. The real culprit was the terrifying fragility of a system where human judgment had been removed from the equation. For decades, the market was Disneyland for adults, a place of screaming brokers and manual trades. But by the late 2000s, the loud guys and suspenders were gone. High-frequency trading algorithms became the primary engine of global finance. These programs are designed to buy and sell thousands of shares in fractions of a second, making decisions based on mathematical models far faster than any person could react. Wall Street's architects believed that substituting human emotion with these automated models would neutralize financial risk. Instead of optimizing the market, they built a digital powder keg. By trusting these black boxes to manage the economy, they created a system that could spiral before a human could reach for the kill switch. The spark that ignited that powder keg didn't come from a boardroom. It started on this quiet suburban street in London. Navinder Singh Sarao was a day trader working out of his parents' house. He realized that if the market was run by code, he could win by simply tricking the software. In the 1990s, Jordan Belfort used a boiler room of screaming brokers to manipulate victims. Sarao achieved the same deception alone, using a script to gaslight Wall Street supercomputers. He used a tactic called spoofing. Imagine you want to buy a rare video game for cheap. You flood the market with thousands of fake sell offers at a low price, tricking every other seller into lowering their own prices to compete. Once the price hits the floor, you delete your fake offers and buy the real asset for pennies. Sarao automated this process with millions of dollars. He wasn't trading against people, he was exploiting the reactive nature of the algorithms. On May 6, 2010, the market was already jittery over European debt. Then Sarao activated his program. The Wall Street algorithms looked at Sarao's wall of fake sell orders and immediately hallucinated an apocalyptic economic collapse. The system was designed for speed, not verification. Every bank's algorithm was programmed to watch and mirror the behavior of its peers. When one machine began panic selling, the others followed in a digital feedback loop, liquidating positions at an impossible scale. The machines were no longer connected to the real economy. They were trapped in a mathematical death spiral, driving the market into a straight vertical plunge. Just 36 minutes after it began, the algorithms hit an automated circuit breaker and paused. During that pause, the fake orders vanished and the code stabilized. The market shot right back up as the machines realized the collapse they were fighting didn't actually exist. $1 trillion evaporated and reappeared, while human traders were still trying to figure out what they were looking at. This same philosophy of automated authority drives the modern obsession with AI black boxes like Palantir. These systems process data and make decisions faster than human comprehension, leading corporate leaders to trust the output of software they don't actually understand. The 2010 flash crash proved that when you hand the steering wheel to an unaccountable black box, you don't eliminate human panic. You just automate it to happen at the speed of light. Thanks for watching Irony Economics. If you enjoyed this look into the madness of the markets, hit that like button, subscribe, and let me know in the comments which multi-billion-dollar disaster we should decode next.